Welcome to another edition of Focus on Alternatives, sponsored by ADISA, the Alternative and Direct Investment Securities Association. For more educational content like this, you can check out the resource library at adisa.org. My name is Geoffrey Dohrmann. I'm the CEO of Institutional Real Estate Inc., the publisher of Real Asset Advisor magazine. And I'm joined here today by Matthew Iak, Executive Vice President and Director of U.S. Energy Corp. Today we're going to be focusing on whether or not it makes sense to be investing in oil and gas during the Elon Musk net zero carbon era. More specifically, we'll be taking a closer look at some of the opportunities available when investing in the energy section today. We're going to explore whether carbon-based investment programs like oil and gas can ever be ESG compliant. And we'll also be looking at some recent developments on the political, regulatory, and legislative areas that might impact the long-term performance of these kinds of investments. So the first question I have for you, Matt, is how can an investor get their arms around the idea of investing in fossil fuel-focused investment programs at a time when so many people are focused on achieving net zero carbon emission targets?
It's a big question. So what's interesting, I don't think people really listen to the word net carbon and kind of think through what the UN's goals are when it comes to creating a net carbon future by 2050 or 2035. Ultimately, the concept is that you're emitting as much carbon and that you're taking out of the atmosphere. It's not a gross net, it's a net. So I think one of the interesting dynamics is when you look forward on the projections, even in the most aggressive carbon reduction cases, you're still increasing the use of fossil fuels dramatically in the next 20 to 50 years. So I think a part of it is more of what you're sequestering out of the atmosphere, more so than what you're gross putting in. So you are trying to reduce the growth of future consumption, not necessarily curb all consumption on a go-forward basis. You're just trying to curb the growth in the consumption and then create more extraction of carbon out of the atmosphere. So even in the most aggressive of all scenarios, carbon is still the majority of our energy consumption for the next 50 to 100 years.
And there have been great strides made in alternative energy sources and developing those resources.
Yes, sir.
But how much are our economies still dependent upon oil and gas resources to power our energy needs?
Almost wholly. So interestingly enough, only half of the growth of consumption, so just the growth in consumption, only half has been met by all of the money that we've put in renewables. So we're not even meeting the growing demands, no less replacing the existing demands. So there is a lot more investment that needs to be made in the renewable, in almost an infinite amount, to try to dwindle into the existing level of production that we're using in fossil fuels. So unfortunately, 2018, 19, 20, even with massive investments, we're way short on already our renewable goals globally, and we're consuming more oil and natural gas, and unfortunately more coal as well.
So it sounds like I already know the answer to this question, but I guess with the rise in the renewables that has gotten and captured the imagination and attention of a lot of the advisors out there, should investors really continue to look for investment opportunities in oil and gas?
I think they have to. I think it's almost socially a necessity. We're actually starting to see the consequences of too little investment in the traditional fossil fuel space because of all the pressures from government, regulators, compliance, and just the imagination, as you talked about, of investors. And what you start to see is with the lack of production coming from traditional fossil fuels, you're starting to see a dramatic rise in price in oil and natural gas. Prices have risen just dramatically recently, which causes a worse inflation problem that we're already getting into from other mechanisms. So ultimately, people don't realize that the diminishing reserves and how rapidly production declines. Ultimately, if we don't invest more in the space, we're going to have a massive price increase on the other side that really we can't globally afford, and it'll really hurt the poorest of nations the most, who can't afford to compete for high energy prices. So it's almost an imperative that we invest more in both sides of the aisle, the renewables and the non-renewables, to meet our global demands.
So how would you characterize the investment characteristics that an oil and gas investment program can bring to an investor's portfolio? What can it do by adding oil and gas to the portfolio do for the portfolio's performance?
So there's a host of mediums that people can use to invest in energy, all the way from debt to the public market to private securities. I think the one thing that energy does, traditional fossil fuels probably do better than most sectors is they generate a higher cash flow. So in one way or another, however the tools are designed, the ability to generate excessive cash flow is kind of unique to this sector, right? Because you're drilling a well and you're producing so much of the reserves that in essence is generating a lot of short-term cash flow. So however the design or the architect of a fund is, I think that's really where the biggest benefit. There's also tax benefits that exist currently and may into the future. We'll see how this administration treats them. But we structure a host of different, from qualified opportunity zones to tax abatement drilling funds to 1031 exchanges. You'll see a bunch of private securities in the marketplace. There's a lot more than just one way to participate. I think the single biggest benefactor would either be taxes or high cash flow in that sector compared to most other sectors.
Well, ESG is a concern to a lot of investors. So is there a way to invest in oil and gas that is environmentally sustainable and that is socially conscious?
So those words are really important that you just used. Because the word impact, ESG, environmental social governance, sustainable, they don't mean the same things, and we throw them together in a very loose conversation. Renewables by their nature can't be sustainable because they're a diminishing return. Ultimately, you're producing it and it's no longer being made, so it's not really sustainable by that measure. From an ESG perspective, environmental, social, and governance, it absolutely should be part of the portfolio in terms of all of the broad spectrum of what ESG does. And really, I think where the future is in traditional energy is working with companies that are ISO certified, like ISO 14001 certified, where they meet compliance standards in terms of the fact that they don't flare and they put it into pipeline, that they do everything right from an environmental stewardship standpoint, as well as the diversity and inclusion part and the governance part of the companies, right? So I think from an ESG perspective, it is. I think if you're purely pulling out sustainable, no, right? So I think if you really dissect this forward-looking movement, we all throw everything environmental into the same bucket, and it's not, right? Like doing great for the communities and creating great jobs is a ESG goal, which oil and gas can do very well. It can drive revenue for areas, it can produce, and it can do it in an environmentally friendly way by not having any emissions. It can't be renewable by its very nature. So the answer is yes and no. I think everyone should require minimum levels of ESG compliance, if not maximum levels to this sector. And it shouldn't be arbitrary to saying how much did you invest in solar or in a renewable. It should be what did you do to make sure that you did the best job with the resources that you have and handle everything from water reclamation to flaring, you name it. So the answer is yes, but to really learn and to be more specific than just saying impact, so sustainable, you really have to be specific and understand what part of the verticals you're covering and you're not.
I would imagine it makes a difference who the operator is and who's really running the program in terms of how they approach those things.
1,000%. And so some of the best things is the majors really do a great job. They're exceptionally good at meeting these ESG standards because if you look at a lot of their stock price movement, it moves more on their ESG compliance than it often does on energy prices. So they're being rewarded for it. So following that type of model, not doing things for the sake of doing them, but actually getting better results can be a phenomenal way to use as a guideline and a metric for great companies.
So should a smart advisor be advising people to move into oil and gas, to renewables, or both?
So I'm going to say both, I think for two opposite reasons. So, if you were looking at a pure valuation and you're in finance and you're saying, what are my multiples on renewables? Well, they're basically where tech was in '99. That's a tough answer to say, I want to invest in renewables when I know you're in the top of a bubble. It doesn't mean it's ever going to burst, but it's really scary in terms of where their multiples are. So if I'm looking at a publicly traded security, that's a tough pill to swallow. And E&P companies are at their lowest multiples ever. So you would say, well, the arbitrage is here. But that's not what it's all about, right? Because it's also going to be what it's going to be worth in the future. So my answer is going to be yes. I think you're going to get two very different things from both sides of the spectrum, right? One is much more of a growth play. If you believe the earnings can catch up to the values of renewables, then it's a growth play, right? Whereas it's not going to be a cash flow play or a tax play. It's much more going to be a growth play. Whereas the non-renewables are probably much more of a total return, much higher internal rate of return. But if in the public market, Exxon might always be seen as a traditional E&P company, exploration and production, regardless of the fact that half its business is petrochemicals and it's more renewable than it is traditional fossil fuel. The world still might price it like an E&P company. So its stock price might not move to match that of a renewable company, even though it actually has more renewables in its portfolio than a renewable company. So you do have to be careful with where the market value is and the perception of value in the type of security. So it's a very difficult answer. I think yes is the answer to invest in both sides of the aisle, because quite frankly, for the global needs of energy, we need to produce everything. We need every windmill, every solar panel, every oil and gas. We need it all, and we need to do it in the most efficient and constructive way. I don't think you'll get the same value from both, right? In terms of one is much more heavy dividend and cash flow, and one's going to be much more heavy growth.
And how about the issue of public versus private? You can gain exposure to oil production capacity in the public markets as well as the private.
Yeah.
What's the advantage of being in the private versus the public, and what are the disadvantages, both sides?
Ooh, that's a big topic. So I think naturally the public market has the single biggest advantage is liquidity. Right? The ability for you as an investor to be able to move in and out of those securities when you believe either opportunity or risk is in front of you. Right? So you can make more in private investments, you're pretty much making an investment and you're stuck in that investment for a significant period of time, whatever that might be, 3, 5, 10 plus years. So I think liquidity is probably the single biggest benefit from the public market. I'll give you a great example. When we look at projects in the renewable space, and we've reviewed hundreds of renewable projects, on a project level, we probably can't make money on more than 0.5% of them. They lose money. But in the public market, if that was a public security, I could trade it 20 times, 30 times what I would trade at as an E&P company. So the value can be there for an investor in the public market where it isn't there on an investment or project level, because the market believes in the future of that versus the today. If that makes sense to you? So whereas in oil and gas, I can make 2 to 3 times as much on a project as what my public market equivalent would get in their publicly traded security. So I can make a 3 to 4x on a well, and yet that company will only be valued at 1 times earnings, because that's where the market values oil and gas today because of what it believes the future is, EV versus renewable versus you name it. So I think it's interesting in different periods of time as the market values different securities, there's arbitrages for private and public, right? So as an example, in the renewable space, there are tax credits for renewables. Unfortunately, they really only work for C Corps. They don't work for you and I unless we have passive losses or passive income. It's really not a valuable tax tool. But as a corporation, the government is basically paying for 105% return on every EV investment I make. So in a renewable space, as a C Corp, I want to invest in a private EV. Even though it will probably lose money on a project basis, the government's paid for 100% of it. So I don't really care, ultimately. You may not be able to take advantage of that, but corporations can, which is why you see a lot of corporations make these investments. Whereas that wouldn't work in a public market, right? So the answer is going to be different. There's all these different arbitrages that are available because of the tax code, because of return profiles, and because of public market perception, right? If I'm in the debt side of the equation, EVs are probably the least risky, like renewables and that side, because the way it's structured with government grants and paybacks, the banks are going to get paid back, right? The original investor is going to get tax benefits, just like we talked about with the corporations. All the money will be back. The equity holders may never make anything, but the debt holders will. So whereas oil and gas can be volatile in pricing. So maybe there's too much risk associated with debt financing an oil and gas company, even though the projects make more money, and less risk on the renewable side. So the answer is up and down the spectrum. It's not one answer. There's a multitude of ways to invest to take advantage of those arbitrages.
And has the secondary market evolved for trading interest in private programs?
Evolve from where to where? Yes.
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 Okay.
I would still say I believe that from what I've seen that so many of these are Reg Ds where the sponsors can't help make secondary markets. So the spreads can be so big you can drive a Mack truck through them. So it's still not efficient yet, but I do see a future of more and more efficiency as they become more popular, right? And if the SEC's goal is to allow more investors into private investments, and it really kind of the opposite of FINRA's goal, right? Depending on who the regulator is. I think if you start to grow that world, I think the opportunity does come. I don't think it's here yet, where there is a closer parallel to creating some liquidity in that market.
Just in closing, how would you want to leave the advisors tuning into this thinking about when it comes to this whole sector?
I would say take the time to open your eyes to the myriad of new investments and concepts that are in the space, and really the changing profiles of energy investing. It should be a larger part of financial planning. I mean, the tools that are available in this space create some of the greatest financial planning arbitrages in history, right? Whether it's a mega Roth through a qualified opportunity zone, which is basically allowing wealthy investors to put money in tax-free accounts, or it's these tax arbitrages through IDCs or tax credits through renewables. It's such a massive part of financial planning that you can do things that you can't do in most other asset classes. And if you don't know them, and you don't know which arrows in the quiver to use for different clients based on either their preference for investment, their tax returns, or their risk profile, I think you're missing out on a market that just has such an amazing opportunity. I would just tell people to get educated and only use it where it's appropriate for clients.
Well, obviously product sponsors are one place they can go to get educated, but what other resources could you recommend to people to become more educated? I would assume ADISA has some information about that?
Yeah, ADISA is a great organization. It's probably the best because you'll get candid conversations from companies that do due diligence on sponsors who are unbiased to, I'm going to give you a biased opinion of what I think is best because I sponsor certain funds. So I definitely think coming to an organization like ADISA, where you can get this open conversation with a lot of different investment firms and a lot of different advisors and those who review products versus just the sponsors themselves. But biasedly, yeah, come to me. I'd love to give you all the answers.
Of course.
At least my answers.
Of course, of course. Well, thanks, Matt, for speaking with us today, and thank you all for joining us. For more information about investing in the oil and gas sector, or to see other videos from the Focus on Alternative series, just tune in to adisa.org. Lots of resources there for you. Thanks again for tuning in.